Welcome back to Financial Fundamentals, where we break down money concepts in a way that actually makes sense. Today, sit back, listen up, and learn about inflation, what it actually is, why it quietly chips away at your money even when you're not paying attention, and what you really need to understand about it to make sense of your everyday financial life. By the end of this video, you'll know how to look at a paycheck, a savings account, or a price tag in a whole new way. Let's get into it. Here's a question to start us off. Have you ever heard your parents or grandparents say something like, "Back in my day, a movie ticket cost $1.50, and maybe you laughed because now that same ticket costs $15 or $20. That's inflation at work. It's not magic, and it's not a conspiracy, it's just the steady, gradual rise in the prices of things over time. And understanding it is one of the most useful things you can do for your financial life, because inflation touches everything: your groceries, your rent, your gas, your tuition, even the money sitting quietly in your bank account right now. So let's start at the very beginning. What exactly is inflation? Inflation is the general rise in the price level of goods and services over time. When inflation is happening, each dollar you have buys slightly less than it did before. The dollar doesn't disappear from your wallet. The number on the bill doesn't change, but its purchasing power, that phrase just means what it can actually buy, quietly shrinks. Think of it like an ice cube sitting on a warm counter. It's still there, it just gets a little smaller every hour. Now, how do we actually measure inflation? The most common tool is called the Consumer Price Index, or CPI for short. That phrase just means a regular survey of prices across a wide basket of common goods and services. Things like food, housing, transportation, healthcare, and clothing. Government agencies track what that basket costs from month to month and year to year, and the percentage change in that cost is how we talk about the inflation rate. Different countries measure this in their own ways, and the exact numbers vary depending on where you live and when you're watching this, but the concept is the same everywhere. Okay, now let's talk about something that trips a lot of people up, and it's honestly one of the most important ideas in all of personal finance. It's the difference between nominal value and real value. Nominal, that word just means the face value, the sticker price, the number you actually see. Real, that word means after adjusting for inflation, what something is actually worth in terms of buying power. Here's why this matters. Let's say your employer gives you a 4% raise this year. Sounds great, right? But let's say inflation that same year is running at 3%. Your nominal income went up 4%. But your real income, what you can actually buy with that money, only went up by about 1%. The rest of that raise was essentially eaten by rising prices before you could even enjoy it. Think about that for a second. That's a concept that most people go their entire lives without fully grasping. A raise isn't always a raise in the way it feels like it should be. The real question to ask is always, is my income keeping up with inflation? Now let's talk about where inflation actually comes from, because it doesn't just appear out of nowhere. There are several main causes. The first is what economists call demand pull inflation. That just means too much money chasing too few goods. When lots of people want to buy something and there isn't enough of it to go around, sellers can charge more. Classic supply and demand. The second cause is cost push inflation. That means the cost of producing things goes up. Things like raw materials, energy, or labor, and those higher costs get passed along to consumers through higher prices. You might have noticed this when fuel prices spike. The cost of shipping products goes up, and eventually that shows up in the price of almost everything. Third, there are supply shocks. These are sudden disruptions to the availability of key goods. Think about an energy crisis, a global shortage of a specific component, or even extreme weather wiping out crops. These sudden changes can send prices upward quickly. And fourth, there's the role of money supply. When more money circulates in an economy, whether through government policy or other means, and the supply of goods doesn't grow at the same pace, prices tend to rise. More dollars chasing the same number of things. Central banks, those are the institutions that manage a country's money and interest rate policy, like the Federal Reserve in the United States or the European Central Bank in Europe, generally aim to keep inflation low and stable. In many developed countries, the target is around 2% per year. But that target and the actual rate varies significantly from year to year and country to country. Inflation can run much higher or much lower depending on economic conditions. And there have been periods in recent history where inflation has spiked well above that 2% target in many parts of the world. Okay, let's pause and recap what we know so far, because we've covered a lot of ground. Inflation is the general rise in prices over time, which reduces the purchasing power of your money. We measure it using tools like the Consumer Price Index. Nominal value is the number you see. Real value is what that number actually buys after inflation. And inflation can come from many places. High demand, rising production costs, supply disruptions, and changes in the money supply. Central banks try to manage it, though they don't always succeed perfectly. Here's your check for understanding question. If you received a 3% raise this year and inflation was also running at 3%, how much better off are you in real terms? The answer is roughly zero. Your purchasing power stayed almost exactly the same. You're running in place, not moving forward. That's one of the quieter realities of inflation that most people don't fully feel until they sit down and think it through. Now let's talk about how inflation affects your savings, because this is where it gets really personal. Cash that sits in a checking account or a low-interest savings account can slowly lose purchasing power when inflation outpaces the interest you earn. Let's say your savings account pays you 1% interest per year, but inflation is running at 3%. At the end of the year, you have more dollars than you started with, but those dollars can buy less. Your real purchasing power has shrunk by roughly 2%. The money is still there, every dollar is accounted for, but it buys less of the real world. This is one of the most common misunderstandings people have about money. Keeping cash in a checking account feels safe, and in the short term it absolutely can be, but over long stretches of time, if the interest you earn consistently falls behind inflation, the real value of that money quietly erodes. Inflation also affects borrowers and lenders in some interesting and sometimes counterintuitive ways. If you have a fixed-rate loan, meaning the interest rate on your debt stays the same no matter what, and wages and prices rise with inflation over the years, that debt can become cheaper in real terms over time. You're eventually paying it back with dollars that are worth a little less than when you borrowed them. On the other side, people who are on fixed incomes, like certain retirees, or who are holding long-term bonds that pay a set low interest rate, can lose purchasing power if inflation rises above what those instruments are earning. None of this means any single choice is right or wrong for everyone. Every person's situation is different, but understanding how inflation interacts with debt, savings, and income is a genuinely powerful thing to carry with you. Let's walk through a concrete example now. And just to be clear, these are illustrative numbers to help make the concept click. They are not predictions about the future. Imagine your regular grocery run costs $100 today. If inflation runs at 3% per year, that same basket of groceries would cost roughly $103 next year. Not a huge deal. But look at what happens over time. After 5 years, that same cart costs around $116. After 10 years, roughly $134. Same groceries. Noticeably higher price tag. Now imagine you have $1,000 sitting in a savings account that earns 1% interest during a year when inflation is running at 3%. At the end of the year, you have $1,010 in the account. Nominally, you made $10. But in terms of real purchasing power, what that money can actually buy, it's closer to what $980 could have bought you a year earlier. A small but real loss. Now multiply that effect over 5 years or 10 years, and you can see how the gap between nominal and real can really add up over time. Here's a question worth sitting with. When you think about money you're saving or setting aside, do you ever think about whether it's keeping pace with inflation? It's one of those things that feels abstract until you run the numbers. And this is exactly the kind of thinking that Financial Fundamentals exists to help you with. Not to tell you what to do, but to make sure you understand what's actually happening with your money. There are things people commonly think about when they recognize that inflation is a factor in their financial lives. Things like negotiating wages with the real cost of living in mind, looking for savings options that offer better interest rates, or diversifying how they hold their assets over time. But every one of those approaches has its own trade-offs, its own risks. And what's appropriate depends entirely on your personal circumstances, your timeline, and your goals. There's no one-size-fits-all answer. And anyone who tells you otherwise deserves some healthy skepticism. Before we close out, let's quickly clear up a few things that often confuse people. First, falling inflation does not mean prices are falling. It just means prices are rising more slowly than before. That's called disinflation. Actual falling prices is called deflation, and it's actually quite rare and can come with its own economic problems. Second, getting a raise does not automatically mean you're better off. If your raise is smaller than the inflation rate, your real income went down even though your paycheck went up. Third, keeping money in a checking account is stable in the sense that the numbers don't drop, but it's not immune to inflation. The purchasing power of that money can quietly erode over time if interest earned consistently falls behind inflation. So here's the one big takeaway from everything we've covered today. Inflation is the gradual rise in prices that quietly reduces what your money can buy, and understanding it means you'll never just look at a number, whether it's a salary, a savings rate, or a price tag, the same way again. The real question is always what that number buys, not just what it says. That's the kind of thinking that Financial Fundamentals is all about. Real understanding, not jargon. Honest explanations, not hype. Just the fundamentals of money explained clearly. If this video helped you understand inflation a little better, please give it a like. It really does help other people find this content. And if you know someone who's been confused about why prices keep going up or why their raise doesn't feel like a raise, share this video with them. That's exactly who we made it for. Drop a comment below with any questions you have about inflation or anything else in personal finance you'd like us to break down next. We go through every comment, and your questions genuinely shape what videos we make. And if you haven't subscribed yet, now is a great time. We're here every week breaking down another financial fundamental, one clear explanation at a time. This video is for educational purposes only and is not financial advice. Markets and investments carry risk, including the possible loss of principal. Always do your own research and consult a licensed financial professional before making investment, tax, or money decisions.